Let me get down to introducing to you our facilitator of today, Elmine van der Merwe. Elmine has more than 20 years of experience in the areas of risk management, and she's based in South Africa where she has worked during this period. So Elmine, I will leave it to you to introduce yourself to our listeners today. Elmine, over to you.
Thank you so much, Jerry. Thank you all for joining us this morning, and for, as Jerry mentioned, the second webinar presenting risk management credit scoring. As Jerry mentioned, I have more than 20 years experience in the banking environment, of which audit, risk management is my fortes. I've worked with banks all over the world, worked in a microfinance institution in South Africa for a lot of years, and I've also worked with community banks in Germany, lots of banks in Africa, in China and in the East. So having said that, let's jump into the webinar for today. It is quite a long webinar, so I am going to move a bit fast for us, given that we have started late. If you have any questions, please feel free to add them in the questions box, and Jerry can refer them to me at the end of the webinar. In this webinar today, we will recap on the previous webinar, Introduction to Credit Scoring. We will look at strategic considerations, goals and expectations of a credit scoring system. We will cover the design approach, including project management, timelines and costs, looking at data, where to start on data management and analysis. And the webinar will cover the implementation phase as well as testing and amending the system. Lastly, we will look at lessons learned. So let's recap. Let's begin with just 3 items from our March 2013 webinar. The completed webinar can be viewed on the SBBN web community portal and includes a lot of other interesting and advanced items. What is credit scoring? Credit scoring is an objective risk management tool used to rate customers based on the probability of a business event or customer action resulting in profitable decision making. Business event or customer action such as a timely credit return, risk of default, retention or cross-sale. A profitable decision such as accept or reject credit application, increase or decrease the credit limit, send, hold, cross-sale offer, etc. Scoring is the most widely used in lending for all stages of a credit life cycle, from borrower acquisition to customer management to debt collection and recovery. Credit scoring uses quantitative measures of the performance and characteristics of past loans to predict the future performance of loans with similar characteristics. Credit scoring is a scientific method of assessing the credit risk associated with new credit applications. Models derive predictive relationships between application information and the likelihood of satisfactory repayment. Models are empirically designed, that is, they are developed entirely from information gained through prior experience. Therefore, credit scoring is an objective risk management tool, as opposed to subjective methods that rely on a loan officer's opinion. Clearly, credit scoring is a risk management tool. Scoring systems can help a bank ensure more consistent underwriting and can provide management with a more insightful measure of credit risk. So why do we do credit scoring? Scoring technologies can be used as an objective risk management tool, as we said, which help ensure centralized, uniform, more consistent and reliable decision management across your organization. Quality and profitability of scoring-based operational decisions can be statistically monitored and gradually improved or adjusted to new market conditions. There are several types of credit scoring. Firstly, application scoring. Application scoring quantifies the risks associated with loan applications by evaluating the social, demographic, financial, and other data collected at the time of the application. It facilitates customer acquisition decisions. Used in application processing systems, application scoring helps to automate the whole process of loan origination. Behavioral scoring. Behavioral scoring quantifies the customer behavior to improve your credit portfolio management and customer management. Behavioral scoring helps you to better understand your customers, and the better you understand your customers, the more effectively you can respond to their individual needs and increase your bottom line. It facilitates customer management decisions used in credit management or portfolio processing systems. Behavioral scoring helps to automatically segment and rate accounts, customers, and portfolios, thus allowing managing efficiently a particular borrower's credit account as well as the entire credit portfolio. Collection scoring. Collection scoring quantifies the probability of recovery of the outstanding balance for those accounts in collections. Collection scorecard statistically estimates debtor willingness to pay and ability to pay, and thus helps to define the actions should be done to increase collections. It facilitates debt management decisions used in debt collection systems. Collection scoring helps you improve your collection and recovery efficiency, reduce write-offs, and decrease staff costs. You also get fraud scoring that rank order applicants according to the probability that an application may be fraudulent, and thus alerts you of potential fraudulent applications through your book on account. Psychological scoring is quite a revolutionary idea whereby customers are profiled based on computer-based credit screening. So let's move on to the strategic considerations. Is credit scoring right for your bank? This is a strategic question that should be answered by all role players in the credit function. Is your bank entering a new market? What are the loan approval turnaround times of the competition in the new market? Given the current approval structures of your loans in your bank, are the loans profitable? Are your credit policies, structures, and procedures in place? These are types of questions that should be answered to establish if your bank is strategically ready for the credit scoring implementation commitment, or if there are certain basic policies and structures that need to be put in place first before you commit to the time and cost of implementing a project of such a nature. A credit scoring system not only has to fit well within a bank's institutional business strategy and technology plans, but also it must be integrated into the bank's policies, procedures, and limits. While a scoring system can and probably should recommend certain policy changes, these should refine rather than redefine the bank's overall credit policy. Banks have been using credit scoring successfully for nearly 20 years to make decisions on consumer loans for vehicle finance, personal lines of credit, and credit cards. Recently, more and more banks are realizing the value of credit scoring small business loans. The credit quality of a small business often mirrors its principal credit behavior. If the principal of a business does not pay personal creditors, chances are good that he or she will not pay a business loan. Designing a credit scoring approach. So how long does it actually take to implement credit scoring in a bank? The simple answer is that it varies. Each bank is a unique entity with unique needs, and a customized solution is dependent on various factors. The actual amount of time and effort required to introduce a credit scoring system in your bank will depend on the amount of time you and your team dedicate to the project, the level of commitment and support from bank, senior and line management, and the time and budget constraints of the technical team. In a perfect world, without any budget or time constraints, It may take up to 18 months to build an expert scorecard where historical data is not available. In the same perfect world with lots of data, it might take only 2 to 3 months to get a statistical model developed. However, keeping in mind implementation, testing, training, and rollout might significantly increase the timeline. There is a direct correlation between the cost of implementing a credit scoring system and the benefits thereof. In all cases, it would involve the cost of a senior person or people to dedicate focus on the project. Other internal labor costs, such as business analysts, risk people, senior people in the credit function, a dedicated team of IT specialists, and preferably internal auditors. This team could be dedicated to the project from anywhere between 6 to 24 months. Should certain expertise not be available in-house, external consultants could cost anything between $10,000 and $70,000. Taking into consideration that most banks do not have the expertise of data modelers in-house, a certain portion of the budget should be allocated to consulting costs. Development costs or specialized software could cost thousands of dollars, depending on the design and the strategy. Having said this, the cost savings for improved efficiency in operations, pricing and provisioning can run in the hundreds of thousands of dollars, depending on the volume of transactions to be scored. Therefore, the payback period for a credit scoring project is likely to be relatively short for banks with significant lending volume in the target segments. Once development costs are recovered, a scoring system can significantly increase long-term profitability. A management steering committee is instrumental in guiding the design, implementation and management of the credit scoring system through its various development stages. The design and implementation of the scoring system involves careful planning and coordination of various functional areas of the bank. So each functional area should be represented in the committee from the outset, or the strategy formulation phase. The SBBN can assist in being a trusted advisor during the implementation of a credit scoring module. Looking at the project steering committee, as with any project, it is crucial to get buy-in from stakeholders. Experienced bankers quickly come to appreciate the great potential scoring holds for improving lending efficiency, consistently implementing credit and pricing policy, and reducing collection times. A management steering committee is instrumental in guiding the design, implementation, and management of the credit scoring system through its various development stages. As already mentioned, the design and implementation of a scoring system involves careful planning among and coordination of various functional areas of the bank. So each functional area should be represented in the committee from the outset, or strategic formulation phase. The key players should be senior managers from each of the functional departments that credit scoring will touch: retail, credit risk management, credit department, IT, legal, and if available, audit and compliance. These people should form your credit scoring steering committee. So let's look at the design approach. The design will depend on whether it's an expert or statistical scorecard and on the credit policies of the bank. The selection of a scorecard type can be influenced by several factors: quality and quantity of historical data on good and problem loans, the extent to which the scoring segment resembles past clients and products, the modeling expertise available in-house and or the cost of consultants, and the limitations of the information technology or IT systems. The quality and quantity of historical data available are the most important factor to determine what type of scorecard should be developed. Sometimes the data are available, but only in hard copy format. This will add additional time and cost to the project budget, as the data then needs to be captured, cleaned up, freed from exclusions and binned. It is also possible to have separate scorecards for first-time borrowers, judgmental application scorecard, and repeat borrowers, statistical behavioral scorecard, as well as a collection scorecard, which can be a hybrid of the two. Alternatively, one scorecard can be built with a combination of factors that makes its one score appropriate for several purposes. The following slide depicts a very high-level three-tier approach to designing a scorecard. First, the bad loan must be defined. Bad means a client that will, with perfect hindsight, the bank would have chosen to avoid. It is crucial to determine a precise, quantitative definition of bad for developing statistical models, as these derive numeric relationship between each risk measure and the bad loans. A judgmental model can be developed without a precise bad definition, but requires a definition of bad for testing and validation. It is important that the bad definition fit the institution and its risk appetite. The next step is profiling. Profiling is to make informed judgments in the statistical modeling process. The modeler should understand not only statistics, but also the business of credit, including the financial institution gathers, stores, and uses credit information. Consultants are frequently hired, but not only because they possess this relatively rare combination of skills, but also because they will bring experience from other markets. For an expert model, no advanced statistical knowledge or software is necessary in the profiling phase. Instead, a panel of credit decision makers should discuss which factors guide their current decisions. One technique is to rank the risk factors used in the credit review process according to the perceived importance in determining a client's creditworthiness. Consultants may provide advice during this process, but the bank staff should contribute actively, since they generally have the intuitive, in-depth knowledge of their client base. The list of potential scorecard variables is reviewed to verify or question the strength and direction of each factor's relationship with repayment risk. This debriefing is most important for statistical analysis, where data irregularities or peculiar past customers may have distorted the results. For expert scorecards, it is more of a chance for the modeling team to share the proposed scorecard characteristics with a wider audience for comment. Design involves applying weights to the selected model factors and creating a scorecard. Statistical model weights are taken directly from the statistical outputs, such as the regression equation, while judgmental model weights are set manually based on the perceived importance of individual factors and the implication of their interactions. It is important to develop in the development process in order to enable the developer to go back later and identify errors or make necessary changes. The following documents are examples of what should be kept by the project office: basic decision taken, data sampling techniques, data quality issues, steps taken with the data or manipulation, and details of backtesting. There is a direct correlation between intention and ability to pay when it comes to small business loans. The nature of microloans to small businesses, however, allows underwriters to reduce both underwriting time and costs by focusing loan analysis on a small number of key indicators indicative of repayment risk. A small business is often managed by one key entrepreneur, and the likelihood of timely repayment is directly related to the entrepreneur's willingness to pay. Many of the small business owners' personal characteristics may be highly predictive of his likelihood to repay, often more so than the business financial health ratios routinely considered in underwriting loans to large companies. Thus, the characteristics of small businesses wants scoring that carefully balances indicators of the small business owner's creditworthiness with anticipated available business cash flow to cover loan repayment. The underwriting and collections of small business loans can be handled more consistently and cost efficiently using custom-designed scoring models, which can be either statistical or rules-based, judgmental, depending on the availability of appropriate data at the time of the model design. A customized, rules-based or expert-based model can be set up in banks that lack a pool of historic small business loan data. The rules-based model can be set up to consistently weight the key factors the bank feels describe the credit risk of a small business borrower and rank order loans from low to high risk by assigning a risk rating. Such risk ratings can be useful for consistent risk-based pricing, credit policy implementation, and prioritization of collections. However, if your bank has significant small business loan data, for example, 3 to 5 years of loan application and subsequent payment performance data for, say, 20,000 loans, you might develop a statistical model. By using logic regression analysis, your data set can be tested and a model can be derived. If you do not have statistical or data modeling expertise, assistance can be outsourced to develop and test the statistical model. Given the amount of data and data cleanup that might be necessary, the time frame for this would be at least 4 to 10 months. Various factors are used to design a scorecard. As we mentioned previously, it is important to ensure that the factors used are identifiable variables that do indeed determine the outcome of a loan. Therefore, the variable factors used should clearly contribute to the good or bad loan classification. With expert scorecards, the outcomes are determined by experts or the steering committee. However, statistical scorecard outcomes are determined by historical data. Credit scoring systems created for the evaluation of new applications are based on the available statistical information or expert opinion which is related to the behavior of former clients with credit. Usually, financial institutions apply discriminant analysis techniques to create these systems, but they lack of good properties due to, for example, the presence of non-normal variables. As an alternative, the future repayment behavior is predicted by the means of the expected number of unpaid installments. The use of this latter variable suggests that appropriate models might be of interest, in which some covariant exogenous variables are included in order to specify the expected level of debt. Looking at data utilization for statistical scorecards, we have mentioned that if a bank has a large pool of loan application, data, and repayment history for small business loans over a multi-year period, it is possible to use the data to derive a statistical model that predicts the risk of a good or a bad loan outcome. Based on the historical data that was used to build the scorecard, the model can indicate, for example, that a given SME client has a 25% likelihood of experiencing average arrears of greater than 7 days or one spell of arrears greater than 30 days. Such a model can be tested and validated prior to use. Given at least approximate loan cost and profit information, the bank can then quantify its appetite for risk in terms of profit it will realize by granting or rejecting loans at a certain probability level. We have said that statistical models are the most powerful scoring models, and building one generally requires an initial data loan pool with ideally more than 2,000 bad outcomes. The actual factors in any custom statistical small business loan model will be determined by testing, although some key indicators are likely to be found predictive in many models. Statistical scorecard development requires specialized skills and software. Banks who have the data to develop statistical models will find that the majority of the model development time is spent on preparing the data for modeling. As a rule of thumb, the larger the set of development data, the more time will be necessary to clean the data, calculate variables, set bin ranges for categorical values, and so on. The more variables that are selected for the final model, the more programming work will be required to develop a test model, program a scoring model, and link it to the IT system. The more data involved in scorecard development and implementation, the longer we should expect to work on the scorecard in all phases of the project. Looking at data utilization for expert scorecards. Expert scorecards characteristics are selected and weighted using the expert judgment of experienced lenders or consultants. Although the bank does not have historical data to base the scorecard on, the expert lenders should have enough experience in lending to base their judgment on informal historical data. The danger with this is that the experience on which the characteristics and weightings are based might not be relevant to the target market and book of the bank. Judgmental scorecards weights should be set carefully. The scorecards should be tested on a combination of actual clients and hypothetical future clients to ensure that the scores adequately represent risk profiles for which the bank is prepared to prescribe standard policies such as approve, reject, review, and require additional securities. A number of characteristics can be used to populate the scorecard, namely demographics, meaning gender, year of birth, marital status, and highest education. Household information, number of people in the household, become very relevant in some countries. Household assets, homeowner status, years at residence, number of rooms, vehicles owned, etc. Business demographics, the sector, the type of business, years in the business, the number of employees. Financial flows, business revenue, household income, rent payment, looking at the balance sheet, total assets, total liabilities, formal and informal debt, and total equity. Repayment history, the number of loans, the longest spell in arrears, days in arrears per installment. Credit bureau information, if that is available, looking at the bureau score, and presence on a blacklist. Quantified subjective judgments like managerial skills, cash flow variability, and business prospects. Loan characteristics such as the amount requested, the type of loan, the borrower's contribution to financing. So where do we start with data? This slide depicts the credit process. Just keep in mind that it's oversimplified and a number of the steps are left out for demonstration purposes. We have covered a laundry list of characteristics that can be used to populate a scorecard. We have also said that in most circumstances, the owner or entrepreneur's characteristics will closely resemble that of the SME in terms of default risk. Some of the character variables might be past records of the client or credit history, stability and duration of business, experience and qualification, and reputation. This simplified process depicts the stages at which data are captured. In the application stage, the loan officer captures the information available, namely the name of the business, the name of the owner or owners, personal details, household demographic, and business demographics. At this stage, and depending on the internal procedures, the loan officer might decline the application or opt to continue. It is extremely important to ensure that the critical information is captured for all loans. This can be done through a manual checklist or be prompted by your system. A completeness review must be done in order to check that all the critical documents and information has been received before the application is transferred to the credit review and risk assessment stage. This is critical as incomplete data capturing will result in the particular loan being deleted from the data used to build your scorecard. The execution of the credit review is based on external and internal data on the credit applicant. Especially for extensive exposures, considerable resources may be tied up in the process of collecting the data, checking the data for completeness and plausibility, and passing on the data to people in charge of handling, analyzing, and processing the exposure within the bank. External data can be requested if a reliable credit bureau is available. We have often seen that the data submitted to the credit bureaus are not reliable to use in scorecards. There are many reasons for this, one of which is that banks feel that they have taken the risk to grant a specific SME a loan. So should they now disclose this client on the credit bureaus, it would make it so much easier for another bank or MFI to poach the client from them. At this stage, it is important to capture the data on the system in order to build your credit scorecard, even though a lot of manual processing is happening at the back end. The client contract details are also preferable to be captured, for instance the differential interest rate and the reasons thereof. Throughout the life of the loan, data should be captured in terms of late payments, changes in risk profile, defaults, etc. It is important to capture true and accurate information about the life of the loan, as the bad definition will be based on these loans, defaults and late payments. A common question is whether repeat loans be captured on the same database as new loans. I personally prefer to capture repeat loans separately and build a separate database on these loans. The reason being that it will enable you to apply differential pricing, ascertain customer loyalty, assess why a certain customer did not apply for repeat loans at your bank, etc. Looking at data collection and how it fits into database management. Depending on the expertise and in-house knowledge, a history database can be built by the bank itself, or an off-the-shelf solution can be built. There are several companies providing these solutions. However, a proper due diligence should be done on the supplier. It has to be kept in mind that the database will be used for a great number of years. Therefore, the sustainability of the company should be assessed. Maintenance and upkeep of the database should be specified. Capacity handling of the database, integration with other systems in the bank, etc. The plug-and-play solutions does make the implementation timeline shorter and relatively easier due to the fact that they already have preset variables which the bank can review and add or delete. Another benefit of off-the-shelf packages is data manipulation. Software packages such as SDATA, SAS, SBBN, and others facilitate a range of analytical techniques, from relatively simple cross-tabulations and classification trees to more complex neural networks. Some of these packages allow you to perform application and behavioral scoring to assess and control risk within existing consumer portfolios and to improve acquisition strategies. For enterprise data access and collection, as well as predictive analysis, you'll get a better understanding of the specific risk characteristics and subsequent attributes that lead to delinquency, default, and ultimately bad debt. Normally, the plug-and-play solutions already have linkages to the national credit bureaus, if there are any, and this would save a lot of cost and time in developing. We have looked at all the benefits of an off-the-shelf solution. However, as we mentioned earlier, it is crucial to ensure that your service provider is a reputable, long-standing company. The data can be captured directly onto the system by the loan officer, or the existing manual processes can be captured by the back office. Both of these methods have pros and cons. Should the loan officers capture directly onto the system, there might be inconsistencies and errors which might result in valuable information being lost. However, by capturing themselves, the loan officers will become familiar with the new process, which will make the transition from existing to new scorecard easier. Back office capturing might contribute to additional costs in terms of labor, office space, etc., but the control over the quality of data being captured might balance the additional costs. Remember, a scorecard is only as effective as the data that it is built on. Therefore, the additional cost of back office capturing might save the bank in the long run. We have looked at the types of scorecards, data utilization, and where the project will fit into the bank. To put everything in perspective, I would like us to spend a minute on the holistic picture of building a scorecard. To develop a scorecard, we use historical data from the credit portfolio that have been freed from invalid records. Each record in the portfolio must have one or two possible values that characterize the borrower's credit behavior, either as good or bad. After historical data have been prepared, the following actions must be performed to develop a scorecard. Sampling preparation to train the scorecard, preparation and selection of borrower characteristics that are used to develop the scorecard, including binning, development of the scorecard, assessment of scorecard quality, implementation of the scorecard, and its subsequent monitoring. So what do you need to start scoring? The most important component of a scorecard is, of course, the data used. Remember that your scorecard can only be as good as the data it is based on. Typically, we use historical data from the credit portfolio to start building our credit scorecard. As we mentioned earlier, if you do not have credit portfolio data available, it is best to start off with an expert scorecard by selecting customers' characteristic and corresponding weights. Once you have built up enough data over a period of time, you can move the statistical scorecard as we are discussing now. In any database, there are likely to be some inconsistencies and incomplete data fields. It is important to clean the database of all these incomplete records and using only the consistent, complete data fields to build the scorecard. Historical data should include a set of characteristics and a target variable. All of scorecard development methods quantify the relationship between the characteristics in the input columns and the good or bad performance in the target columns. Exclusions need to be addressed in the data sets. Certain types of accounts need to be excluded from the data set. For example, bank workers, VIP records, etc. And then we get to binning. Binning means the process of transforming a numeric characteristic into a categorical one, as well as regrouping and consolidating categorical characteristics. So why is binning necessary? It increases scorecard stability. Some characteristic values can rarely occur and will lead to instability if not grouped together. It improves quality. Grouping of similar attributes with similar predictive strengths will increase scorecard accuracy. It allows to understand logical trends of good and bad deviations for each characteristic. Prevents scorecard impairment, otherwise possible due to seldom reversal patterns and extreme values. And it prevents overfitting or overtraining, possible with numerical variables. This slide is discussed in detail in the previous webinar, which is available on the SBBN website. Testing and amending the system. Statistical models are based on historical data to determine the predictive relationship between applicant information and loan performance. When testing a statistical scorecard, it is important to test the model against historical data that was not used in building the scorecard. This is called the out-of-sample test. For instance, using a data set spanning 5 years, the first 4 years of data might be used to derive the model, while the final year of data would be used to test the predictive power of the model. Since there is no statistical fallback to test an expert scorecard on, It is recommended that the scorecard be run in parallel to existing loan approval processes. A significant number of loans should therefore be run through the scorecard method, as well as through existing loan approval procedures. The outcome of both these methods should be carefully scrutinized in order to determine the validity and superiority of the scorecard model. The expert scorecard can be viewed as a structured and weighted application of the 5 C's of credit, namely capital, collateral, character, capacity, and covenant, to each small business loan evaluation, with the weightings reflecting internal and best practice experience as to which factors most affect the risk of small business loans. The real work starts once the back-end testing has been finalized. Looking at a pilot testing, depending on the size of the bank and the diversity of clients, a manageable number of pilot sites should be chosen, preferably 3 or 4. It is important to ensure that there is sufficient diversity in the portfolios of these branches as to test all scenarios of loan applications. The skills of the staff at these branches should be of high standard, and existing policies and procedures should be followed rigidly. The number of loans issued at these branches should also be sufficient to adequately test the scorecard against. There are various methods to test the scorecard, one of which is to cease all issuing on existing processes and only issue loans based on the outcome of the scorecard. Although there are many people advocating this type of testing, given that there are certain benefits such as immediate buy-in, etc., I personally prefer another option whereby all loan applications are run in parallel to the scorecard. This method enables you to test the scorecard against your current loan approval procedures and policies. It is also called the Challenger-Champion methodology. The ultimate goal for any bank is to have the most superior method in place, and this methodology enables the bank to measure the challenger, the scorecard, against the champion, existing procedures. Only if the challenger proves to be superior, the bank can continue to the next step, implementation. The pilot testing phase should start with adequate training and scorecard users. Topics to cover include the basics of how the scorecard was developed, organizational goals for using scoring, as well as procedural training. The pilot test training is where we can first secure the buy-in of loan officers. Without the interest and cooperation of loan officers, the pilot test is likely to face delays. We have mentioned that the development of the scorecard might have taken a long time and changes in the credit portfolio might have occurred. Since such changes are not reflected in the data that we use to develop the scorecard, then prior to the implementation of the scorecard in the process of evaluating the borrower's creditworthiness, we need to recheck that the quality of the scorecard remains the same and remove any deviations. In the first stage of implementing a new scorecard, we need to check that it's superior to the existing methods of risk evaluation or to the existing scorecard. If needed, the new scorecard is improved while it is in challenger mode until we see an acceptable improvement in risk management. Once we have established the superiority of the new method and it's agreed and signed off by the steering committee and board, we can proceed to implement the new methodology. In some countries, the central bank requires that they be informed of major changes to operational procedures. It is therefore important to check the central bank regulations in your country and, if need be, get sign-off from the regulators before implementing the new model. The maturity and flexibility of IT systems will influence how best to integrate the scorecard. Remembering that the more complex a scorecard, the more complex will be its integration with the IT system. If scoring's user interface cannot be easily integrated directly into the existing IT system, it may pay to develop a separate application platform from scratch and then link this to the core database system. As with any new project, it is crucial to get buy-in from all stakeholders. Loan officers need to understand the benefit of the scorecard to them and not feel threatened by the change. This process can run in conjunction with the training at branch and head office level. In my experience, having regular updates and feedback from the pilot branches themselves to the rest of the bank goes a long way to assist the acceptance of a new model. So how do you train all the branch personnel on the model before rollout? There are different approaches, such as regional training and branch by branch, but in my experience, the small group hands-on approach promotes dialogue and ultimately better prepares the staff to use the model. Once training has been successfully completed, the system can be rolled out to the rest of the bank. This can be done through a staggered approach or a big bang approach, whereby all branches switch over to the new model simultaneously. With both these approaches, it is important to have an emergency team on standby to address all issues that might occur. Especially at branch level, they should be assured of immediate assistance, as this is not only affects the front office staff, but also the customers directly. After implementation, the developed scorecard is used in real time to facilitate operational decision making. To support the quality of its performance, one needs to periodically, monthly, quarterly or annually monitor the scorecard and to readjust and calibrate the scorecard if necessary. Since the result of scorecard development must be the best at all possible options, the above measured actions is typically repeated cyclically. The following methods can be deployed to improve the quality of the scorecard: changes in training and validation data sets, changes in defined transformation or borrower characteristics, and changes in scorecard development methods. So looking back at a few lessons learned, a scoring model, whether statistical or judgmental, is only as valuable as the bank's management commitment to using, monitoring, and where necessary, refining the model. Scoring is a strategy that the entire organization needs to understand and buy into. Adopting this approach to risk management, and the bank as a whole, needs to be a conscious choice at a very senior level within the financial institution. All phases of the project, decisions and assumptions made should be carefully documented and stored. This is crucial for later reference in changing and adapting the model. Data are one of the most challenging elements of scoring. Data collection, storage and maintenance are an integral part of the successful scoring due to the necessity of the consistent, good quality data. This is imperative for both the development and maintenance of credit scorecards. Since changes in the scorecard are inevitable, the system needs to be built in a parameterized way rather than hard-coded. This will mean that changes to the scorecard can be implemented easily through modifying variables in the parameters rather than changing the hard code. Lastly but not least, reporting and validation checks needs to be carefully developed to enable easy management of the scorecard, such as vintage reports, roll rates, and population stability reports. The true value of the scorecard is limited without the ability or the power to monitor and manage the data. In conclusion, scoring models support the decision-making process by eliminating subjectivity and using of the statistics. Scoring helps increase the profit by accurate profiling of customers and optimize credit analysis procedures. Thank you so much for your attention. If there are any questions, we'll be happy to taking them and answering now.
Elvin, we have a few questions, but first, thank you very much. My head is reeling, and I'm sure everyone else is, with the vast amount of data and the very in-depth coverage you brought to this topic. So thank you very much on our behalf, and I think on behalf of all the listeners. We have a couple of questions. The first question that came up early in the presentation, I think, when you were talking about design approach, expert versus statistical scorecard, and you spoke about the selection of the scorecard being influenced by several factors. one of them being the limitations of the IT system. And Dorafel Barit had a question of what does limitation mean? Did you mean the requirement of real-time systems?
Jerry, yes, definitely real-time systems, but also in some of the institutions and in the banks that I've worked with, we have legacy banking systems which are not impossible but difficult to change or to have other systems integrate with, and you have to assess the viability of getting new software, buying in software off-the-shelf packages, or converting your IT systems, your existing legacy IT systems. And in the end, it is a toss-up between time and cost for this, and also looking at your expertise that you have in-house in terms of the development and maintenance of these IT systems.
Okay, thank you. And Dorafel, if there was anything more that you need, then just email us and we can send you a more detailed answer also. Another question that came up from, and this time from Darlington Moshi of CBA Kenya, was what is the minimum number of years worth of data that is recommended for statistical scorecards?
That is a very good question, and it also depends on the number of loans that you have, the volume per year. If you are a high volume number of loans per year, I would not recommend using less than 3 years data, because you have to use at least 2/3 for developing the scorecard, and then 1/3 for testing the scorecard. But I think thumbs-up 20,000 loans, of which 2,000 bad loans, of very good quality data, might give you a reasonable statistical scorecard.
Okay, excellent. I have a personal follow-up question to that, but I will bring that up last, because there's one more question from Dorafel Barit, who says that, I noticed that collateral is not being considered at all. Do you have a comment on that?
Collateral is definitely, it forms part of the 5 C's of credit, so it's definitely an integral part of credit and the credit scoring system. I have not covered the collateral part in detail, and surely we can do that at a later stage. But looking at collateral and at your credit decision making, obviously when the decision gets to, or the credit approval decision gets to the yes or no stage, definitely you will be looking at having additional collateral in terms of securing your loan properly. But the collateral, or the 5 C's, should definitely be built into the variables in the scorecard. So although we haven't addressed that specifically, it is definitely built into the scorecard itself, and in the end you can also opt for additional collateral depending on the outcome of the loan scoring process.
Thank you. There's one other question and also a comment which I think would be echoed by many of the listeners, and this comes from Edwina Lupembe, who is the CEO of Mkombozi Bank in Tanzania. Her comment is that to be sure of a rating, judgment as well as long-term experience with the borrower is an added advantage, especially for developing countries. So the point she's alluding to is, can you rely only on the scorecard? And she adds, some customers make a very good impression on the first and second or repeat loans and then default on subsequent loans. So how do you balance the two without looking at asset quality, other assumptions valid to the environment?
Definitely, that is a very good point. In terms of your, and I'm going to split the two scorecards in answering this question. In terms of the judgmental or the expert scorecard, you would have the expert opinion of your bankers, of your loan originators, all of those people in determining the variables and the weight coupled to those variables. My point in that is that the loan officers and the frontline staff and the people working in that market segment knows their customers best. So there would be more of a personal touch and a personal opinion to that variable, which might make your expert scorecard a better rating, if I can call it that. Statistical scorecards are explicitly built on historical data. So although you would get your repeat customers that make a good impression, that have more or less the same characteristics, but will default in the second or third term, there should be, in my mind, a couple of those bad loans that would be reflected in your statistical scorecard. So although the score would reflect probably not as high as a good loan or good customer, it might reflect the score more closer to the cutoff line between good and bad. And there obviously you would have to have your management experience, and that is totally up to the bank in terms of its policies, to say that within the, say for instance, the 5% above the cutoff line and 5% below the cutoff line, the policy says or states that it should be reviewed by management in order to grant the loan, or as the previous question suggested, or ask for more collateral. So there is always that insurety of will a good loan statistically turn into a bad loan. But in the end, the management should make a decision there in terms of that.
Okay. Another question that came up was, and again a very interesting one, does credit scoring have any place in group lending methodology?
Yes, it certainly does. It certainly does. If you have the historical data to build this on, I would definitely say yes. In terms of expert scorecards, I think they would have to go a lot more of thinking into group loans than just the straightforward small business loans or personal loans. But in terms of statistical scorecards, I think that would be very effective in group loans.
There was a question from Baitusham from Kyrgyzstan saying, could we use scoring for analyzing business projects?
It all depends on your variables and what you would use the business project for. Would the business projects form part of your normal credit rating process? Yes, sure. I definitely think that credit or business projects can form a part of your credit scorecard. To use it ultimately just for new projects, you would have to look at the variables that you put in. Scoring is, although we talk about credit, but scoring is used in day-to-day practice for many things. not only for credit. So yes, I definitely think it can be used for that. It's just the question of integrating it into your credit approval process that you will have to look at carefully.
I'd like to put two more questions. One from Savings House, mostly in Macedonia, which says, can you mention some variables or financial aspects of business demographics that would be sound data for designing an expert scorecard, and socio-demographic variables other than status? Age perhaps is the question. And a follow-up to that is, what about with designing statistical scorecard, does regression analysis require very specialized skills and education? So it's two questions in one.
Okay. Looking at the characteristics and variables, a couple of them could be as looking at the sector in which the business is. For instance, let me pull it back to home. In South Africa, we have the mining sector, which is very profitable, and you would basically assess that different to a normal retail sector, and there would be different variables applicable to that. So a couple of the characteristics that you can look at is the sector, the type of business, looking at contracts that the businesses have. For instance, if the business have only one big contract, so most of their profits or most of their income or turnover is reliant on one contract, that is a high risk characteristic, and you would weigh that differently to others. Also looking at the years in business, the number of employees, the repayment history, as we mentioned in the webinar, looking at the shareholder structure. If there's only one entrepreneur, looking at what he has, his repayment history is, and his characteristics is. Credit bureau information might play an important role if you know that the credit bureau information is reliable. Financial flows, obviously looking at your business revenues, what outflows and what inflows of revenues there are. So there's a number of things. What I do think is important is looking at the different sectors and applying the characteristics and variables according to those sectors. It would depend on the sector. Well, it would differ for the different sectors.
Okay, so let me ask the last question for today. And you had mentioned very correctly that data collection, storage, data handling is very important, parameterized systems, reporting, validation, checks, etc. And the cost question also came up from someone else. So my question is, with all this, does a bank, and I'm talking about a small to medium-sized bank, need to establish a separate department, section, number of people internally and assign them full-time, not just to develop a credit scoring module, but also to maintain it thereafter?
Jerry, I think not necessarily. In terms of the project and getting the project launch and the project steering committee and the available resources to the project, I would think that they would probably be full-time in developing and implementing the scorecard. There should, however, be, once the scorecard is implemented, there should be a maintenance team, but it would not necessarily keep them busy full-time. The efficiency of the scorecard must be checked and validated cyclically, either quarterly or monthly, or if something has changed dramatically. For instance, the mining sector has fallen flat. Then you would need to readjust your scorecard, looking at different variables and different ratings. I think in terms of the implementation phase and the project phase, definitely probably 90% to full-time. Once it's implemented, it should only be maintenance.
Okay, thank you very much, Almin. I think that will bring us to the end of today's webinar. And as I had mentioned right in the beginning, we'll keep a recording of the video on the SBBN website. But I also think we'll place a copy of the PowerPoint presentation with your very detailed notes so that people can flip through the PowerPoint at their own pace. Almin, thank you very, very much. It was very interesting. I myself learned quite a bit from it, and I'm sure everybody appreciated. All the participants, thank you very much for taking this time. Thank you all very much for participating today, and we look forward to your participation in our forthcoming webinars.
Thank you so much for attending, and thank you so much for listening in this whole time into a very detailed discussion. If there are any questions, please post them on the SBBN portal and we can answer them online.
Thank you, Almin. And good day to everybody.